The next red flag to go up is when when the Federal Reserve and other central banks come in and buy again. And then the next time, that is a very risky point, is when we have the next economic downturn.
Ray Dalio warns of a serious problem due to rising debt and poor financial management. He explains that governments may print money to pay off debts, which can devalue currency. This cycle has repeated throughout history and leads to economic downturns. Dalio suggests owning gold and inflation-indexed bonds as protection because they are safer in uncertain times. He advises diversifying investments to reduce risk and highlights the importance of having a savings mindset to prepare for tough financial times.
What we have done, my generation, unfortunately, has allowed debt to build up, has allowed infrastructure to deteriorate, has instead borrowed forward. And so if we think about what this debt restructuring and renovation is going to cost, and we think about that's not measured in money. Money just produces productivity. So the work and how we're going to have to be in order to be effective has to overcome that deficit for this giant renovation. So we haven't done it. But back to your first part of the question. The first part of the question is, it's very simple. There are debtors and there are creditors, and the system has got to work well for both. One man's lending has got to be rewarded to compensate for making that lend. And so you have a process. If you accumulate debt, you are accumulating the need to pay back in real terms. You have to pay back the principal, and you have to pay back the interest in real terms. Otherwise, nobody's going to want to lend and the system doesn't work. And the two issues that you have a choice of is to pay that back in hard money. In other words, money of value that's of comparable value, or you have to print money and you pay back in deflated money. And so what has happened over a period of time throughout history, these cycles, by the way, go back to the Old Testament, years of Jubilee, and the same cycle always happens. And there's a tendency for debt to rise relative to incomes that are needed to service that debt. And so you see different societies. In our society, we have high debt service costs, which then will rise as we have large deficits and large amounts of money to pay back. And if that balance is not well achieved, so that the creditor does not receive an adequate amount of compensation, they will sell that debt. They will not hold that debt. And so it's not just the amount of new debt that's created. It is also the amount of debt that is outstanding that could be sold, and therefore create a huge imbalance between the amount to be sold and the amount to be bought. And so in history, it's all repeated in the same way. When that time comes where they have to do that, when they do that selling, and central banks come in and they think they're saving something because they're printing the money in order to pay back the debt, as has been done, monetization, as we call it, that creates a bad compensation and devalues money. So that's the mechanics. So there's no getting it around it. Wouldn't it be wonderful if it was like that, that you could just, that debt didn't matter and you could keep borrowing. But think of it as just you're borrowing a proxy for stuff and it has to be paid back. What happens, and Japan is the worst. So what Japan has done is by printing a lot of money, they have had their currency go down. And so that currency decline is the way it's depreciated. So if you have a bond holder in Japan, they've lost about 80% of their value in their purchasing power. And that becomes the dynamic. That's the same sort of dynamic. So the next thing I think that you're going to see in the United States is you're going to see a squeezing of consumption. So at the federal government level, as the debt service payments are rising and the debts are rising on those, you're going to see the squeeze. There's very little room between entitlements that are fixed payments and the actual revenues that are coming in, you're going to start to see that squeeze. The real issue will become if you start to see the selling of those bonds. When exactly that happens, um, I can't tell you. The next red flag to go up is when the Federal Reserve and other central banks come in and buy again. And then the next time, that is a very risky point, is when we have the next economic downturn. And I think that probably will be within the next 4 years. Cycles, the business cycle lasts about 7 years on average, give or take 3 years. So I can't tell you exactly when it will be, but I would say it's probably most likely within the next 5 years, something along those lines. I think a combination of gold and inflation index bonds would be good. I think that gold also has the benefit of being uncorrelated, or by and large almost negatively correlated with other assets. So it's an effective diversifier. So in thinking of stocks and bonds and so on, if you bring that in, actually you'll lower the risk of the portfolio. So it's very good from a portfolio construction. It's also as a war option. In history, when we have wars, nobody wants to lend to anybody. Even allies don't want to lend to each other because everybody gets in much more debt, and they know that has to be devalued. And the question is, what is the common currency? I think the world is leveraged long assets. That means, generally speaking, most assets are leveraged long. I think when they print money, that'll be supportive to some of those assets, as they always do. But I would expect an environment that would be more like the 1970s or in the 1930s, in which, in terms of real terms, that equities does um, poorly relative to, let's say, hard assets. When you think about what is an alternative money, gold is the third largest reserve currency. Central banks are now buying it. I think that also in institutional portfolios and in individual portfolios, they're underweighted. Inflation hedge assets are. So I would say, my flyer, even though I believe so much in diversification, so I would say I would diversify more. But if I was to say what is it, it would be not just gold, but gold in combination, particularly with some of the inflation index bonds, because gold and inflation index bonds are only 16% correlated, and so they balance each other well, and they're both over the longer term relatively good assets to hold in the kind of environment that I think is more probable than is being discounted, and that I worry about. So it would be an effective diversifier. And by the way, I would say people get fanatical about Bitcoin or they get fanatical about gold. And I think that they have to think more broadly when we're thinking about what is the form of non debt money.
Ray Dalio warns that a major economic downturn is likely within the next few years. He recommends preparing by investing in a mix of gold and inflation indexed bonds, as they are less risky and help diversify portfolios. Dalio believes gold is a good asset because it's independent of other investments and performs well during tough economic times, unlike stocks. He also advises against relying heavily on Bitcoin, as it is more volatile and less stable. The key to investing, according to Dalio, is to diversify, save wisely, and focus on securing long-term needs first.
So the Bitcoin issue is, I believe that you're not going to get privacy in Bitcoin. Governments will follow and so on, and can tax and control however that works. And if an alternative money of any form is threatening to the system, they can shut it down. They can operate in that way. And that the behavior of Bitcoin, in terms of its determinants, um, past behavior of Bitcoin, it doesn't make it clear to me how it behaves in relationship to some of these determinants. Bitcoin is also, just to put it in perspective, it's a relatively small market in terms of, it's like a fraction of, I don't know, a fifth of the size of Microsoft or something, one stock, and there are many stocks. So for all of those reasons, I wouldn't heap a lot of money into that. I have a very small Bitcoin position. I don't, but for those reasons, I would say central banks are not themselves going to take on Bitcoin. Central banks are going to take on, there's a saying, gold is the only asset you can have that isn't dependent on somebody else making you payments. So I would favor gold over Bitcoin for those reasons, but each to their own, and make sure you're diversified, because if the type of environment that we're talking about that comes to pass, you better be able to turn it into hard buying power wherever you want, and probably have it fairly private. I think that's crazy, and I think I've been in the markets for 60 years, 63 years, and I've been through many, many cycles, and I know that wonderful technologies, with large changing of the world technologies throughout history, and I can go back to the steam engine and carry it all the way through. They all have a cycle, and you also don't know who the winners end up being in that cycle. And there are enormous amounts of risk in that dynamic of operating that way. If you want to keep money as a storeholder, well, the holy grail of investing is to find 10 to 15 good uncorrelated return streams, because if you find a number of return streams, a number of investments that are good and uncorrelated, you will have the average return of those. So you don't lessen your return. Just pick ones that are really, really good that you like, but they're not correlated. But you will eliminate up at 15, you'll eliminate 80% of your risk. So you'll improve your return to risk ratio by a factor of 5. Okay. There's no way you can improve your betting on which one is going to be good by a factor of 5. It's a competitive game out there to pick what's going to be a winner. And then also things change in unexpected ways, as we know. I was that person, and I remember going through that journey. And I'm so glad that you're asking me the question, because my purpose of in life now, to a large degree, and my purpose of being on this show is to try to pass along such things. And I remember when I was that age, and I started to have a family, and I started to think about how many months could I live if income didn't come in, and then would go to years. And I would take that number, and I would take my savings, and I would say, okay, let me cut that in half, whatever that number is, because it could go in half with between taxes and performance. I would take that number, and I would start to think about what is it that is going to be most important? What's the purpose and use of that money? If I could immunize myself against the type of expenses, if I could prepay my children's education in a sense, or my living, or whatever expenses, I think that that's the most important things. How do I build that? I would think about, there's liquid savings, and then there's your home, which is your environment. There's certain things, like your environment is very important. And so there's how I think about the home and how that works, and through improvements and forced savings, and also there's taxes. So I would want to take care of the benefits first in that quantity. And then I would try to have that element of diversification. I would view investing as being two types of investing: that investing for the safe money that's going to immunize the expenses that I need to pay, and then the I'm going to speculate kind of money. Because okay, when you try to beat the markets, um, okay, don't be naive. You know, at Bridgewater, we put hundreds of millions of dollars, billions of dollars, to do research to try to beat the markets. So get the basics down well, including the understanding of diversification, and take care of your needs most. I think those are the most important things. Maybe above it all is having a saving mentality. The impact of the saving mentality is enormous.
In conclusion, Ray Dalio emphasizes the importance of preparing for future economic challenges by diversifying investments, particularly through gold and inflation-indexed bonds. As debt continues to rise and financial instability looms, having a well-structured, resilient portfolio is crucial to safeguarding against potential downturns. Stay informed and be proactive in protecting your wealth.